September December 2019 SBR paper question number 3. So question number 3 and question number 4 comes in section B, which both are for 25 marks. So previously I have covered question 1 and 2 of September December 2019 SBR paper. Please go and check them if you haven't. And now today we are going to discuss question number 3. So as you can see, even if you don't read the whole case study, if you don't read the requirements also, just by reading the subheading, you can get an idea which IFRS are more likely to come, right? I can see there is revenue, which means IFRS 15, but it is too early to make a prediction. There could be more into that, more IFRS or IAS included in one. Then we have valuation and revenue, then we have investment. So from this two paragraphs, it's not very clear which IFRS or IAS exactly it is. Pension plan, we know it is IS 19. Now, let us read the requirements first. Advise the director of the DGY company on the recognition and the measurement of. So you have to talk about recognition and measurement using appropriate IFRS or IAS. First one, and it's for 9 marks. So the first part says Clay Music Company shares received as revenue for the sale of the 3-year license and how they should be accounted for in the financial statements for the year ended 31st December 2006. Now if you are seeing that this is, they're selling what? 3-year license. What is it? It is like an intangible asset they're selling, right? So sell 3-year license and how they should be accounted in the financial statements. This is the date. And royalties which Clay Music Company has agreed to pay as a revenue for the sale of 3-year license in the financial statements for the year ended 31st December 2006. Now you have to talk about royalties. Your answer to second part of A should demonstrate how it is supported by the revised conceptual framework for financial reporting 2018. Now, my dear students, when you go to the SBR exam, please make a note of this. A revised conceptual framework for financial reporting 2008. What it is there, right? What is included here? Please know it. How an asset, liability, income, expenses, equity are defined under this. You have to know it. So second part of it should also demonstrate how it is supported by this, not just royalties, right? Coming to part B. Again, it's for 9 marks, but there are 3 parts to that. And when you're answering parts like this, when under a section, when you have different parts, let's say for part B, we have 3 parts. My advice is answer them in order. First part, second part, and third part. The reason why I'm telling you to answer in order is because it is linked most of the time, right? I would say it's linked. The second part will be linked to the first and third will be linked to the first and second. That means you will be needing the previous answer to answer the next. So that's why I recommend that you follow, answer the first, then the second, then the third under part B. So based on the IFRS, so this clearly tells you that no IAS, only IFRS. Advise the directors on the following. Which IFRS comes over which? You should know it. First, classification of investment, which DGY has in 4D company. I will clearly take you through the subheading. Okay, which out of this is required? It is this investment in 4D. That means that comes in part B. The first way is for part A, the derecognition of assets. So first is classification of investment. Next is the derecognition of assets, exchange for the investment in 4D company and any resulting gain or loss on disposal and the financial statement of DGY at the 31st December 2006. That is also related to that only. And third, whether the cryptocurrency should be classified as a financial asset or an intangible asset. This question, when it came, was not answered very well by the students. The reason is because this was new. Each year, no matter how much you prepare, at least one question will be unique. You will never come across such a question in your past paper. So you should expect such a question, right? Even though you cannot write in full because it's a new question, you have never been exposed to that, you have never practiced it, at least you should be able to answer it. You should not leave it like that. At least half or whatever it is, whatever comes to your mind, whatever you can link relating to that IFRS, you shall be able to answer it. Don't leave it incomplete. Okay, so whether the cryptocurrency should be classified as a financial asset or an intangible asset, we cannot tell it now. We'll have to see the facts. To know whether cryptocurrency should be classified as financial asset or intangible asset, what you should know? You should know three things. You should clearly know what is cryptocurrency. You should clearly know what is financial asset and the features of it, how to classify something in financial asset and also intangible asset. You have to know the features, the properties of intangible asset, financial asset, the differences between these two, and you have to see which under which cryptocurrency will fall. That's how you learn. If there is no appropriate standard, you will not see a standard for cryptocurrency. Okay, so don't break your head if you're thinking that there's no IFRS such for cryptocurrency, but there is an IFRS for financial asset and intangible asset. IFRS 9 is for financial asset. For intangible asset, we have another standard. So you answer should also briefly consider whether fair value movements on the cryptocurrency should be recorded. Fair value movements should be recorded in P&L or not. Okay. To know this, whether fair value movements should be recorded in P&L or not, you should know your IFRS 9 very well. That is your financial asset part. Because there only we record fair value. How can we record this fair value? Through P&L or through other comprehensive income. There are two ways. We have to see. 9 marks. C. First part of C. Explain the reasons behind the issue of the amendment to IAS 19. Okay. Understand the question properly. They told explain the reasons behind the issue of the amendment. That means this IAS has been amended. What is it? Planned amendment, curtailment, or settlement? And discuss. So this is one part till here, and after "and" is another requirement. Same but another requirement. And discuss why the changes to the calculation of net interest and current service costs were considered necessary. 3 marks. Marks is very less, looks very easy. When you come to answer it will be very tough for you. Trust me on that. Because this specifically this requirement is not calculation. It's just a discussion question. Why amendment and why the changes to this two are necessary. 3 marks only. 4 marks is for the last requirement. Advise the directors of DGY on the impact of the amendment to IAS 19. What is the impact on the amendment to IAS 19 on the calculation of net interest and current service cost for the year ended 31st December 2006? 4 marks. This should be easy for you if you are very well with IAS 19, right? So by looking at a past paper, never ever predict that this IFRS will come, this IAS will come. Yes, there are some IFRS and some IAS which comes every year, which are very frequent. Those you definitely have to know. But some which does not come frequently, those also you have to know. Okay? Like some small IFRS and IAS. There are so many small. But always when you're learning, learn the big ones first. The major ones first. Finish it off. Finish the hard ones first and then go by the easy ones. IAS 19 is also not, I would say, it's a mixed. It's easy for some, it's hard for some. But calculation part, definitely, sometimes it is tricky. So IAS 19 you have to follow. And now let us go to the first one again, A. Before I read A, I have to read the first. So now if I see, what am I going to read? I'm only going to read this part. This one revenue and this one. Only this two part I'm going to read for my requirement A only. Background. Background, you definitely have to read the background first. Without background, don't read the case study. So DGY has developed a new business model whereby it sells music license to other companies which then deliver digital music to customers. Okay. They're selling license to companies. Those companies are selling digital music to consumers. So DGY is not selling digital music to consumers directly. Okay, understand the business model. So background is very simple. Keep this in mind and then read the case study. Sale of a 3-year license. Now they are selling the license to the company. So DGY has agreed to sell some company, an unlisted technology startup company. Okay, that company is unlisted technology startup company only. A 3-year license to sell the DGY's catalog of classical music to the public. This catalog contains a large selection of classical music which DGY will regularly update over the 3-year period. As a revenue for the 3-year license, Clay Music Company has issued shares to DGY equivalent to 7% shareholding voting rights are attached to these shares. 7%. Okay. DGY has received the shares in Clay Music Company on 1st of January 2006, which is the first day of the license term. DGY will also receive a royalty of 5%. How much? Definitely, if they're selling license, they will receive a royalty. 5% of the future revenue sales of Clay Music as a revenue for the license. Okay, Clay Music valuation and revenue. Now, on 1st of January 2006, Clay Music has valued at between 4 to 5 million by professional valuer who used a market-based approach. This valuation was based on the share price of a controlling interest in a comparable listed company. Because Clay Music is unlisted company, right? So how can they value? How can they get this market-based approach? They got this approach based on some proxy company, similar company, right? Comparable listed company, comparable to Clay Music. So for the financial year end 31st December 2006, sales of classical music was, what is the sales? It is this much. On 31st December 2006, a further share valuation report has been produced by the same professional valuer which indicated that Clay Music was valued in the region of this to this. Before they said it was 4 to 5, now they say 6 to 7 million. So I'm not going to read the second. Investment in 4A, that is for requirement B. Now I'm going to answer requirement A. Requirement A says what? Again, reread your requirements after you read the case study. Okay. I guarantee you that if you have build this habit, read your requirements first, then read the case study, then again reread your requirements to refresh what you have read, to confirm, to clarify that what I have read just now and what you have read in the requirement, now you are able to understand it better. Before you answer, don't just answer assuming that okay, this is what I have been asked. This does not take so much of time if you have practiced time management very well. When you're planning time management, also plan your reading time also with writing. Don't separate it. It comes in the same only. A 25 marks question is for 36 minutes you have to write, because 25 into 1.8. So 36, in this 36 minutes you have to write also, you have to plan also, you have to read also. You have to plan in such a way. Okay. So first one is shares received as revenue for the sale of 3-year license and how they should be accounted for the financial statements. So royalty part I'm not going to discuss now. That is in the second part of it. First we are going to talk about the shares part. Share received as a revenue for the sale, how they are going to be accounted, recognized and measured. So if I see the answer, how you are going to use which IFRS? Definitely it is IFRS 15. And you have to give it a name, subheading, use subheading. Revenue recognition. How you are going to recognize revenue? The word revenue says it is IFRS 15. Now mind you, IFRS 15 is an IFRS which I have seen, which is tested very frequently. Somewhere or the other this IFRS will be fit into a question. It could come in question 1, 2, 3 or 4. But it comes very frequently. So IFRS 15, you have no way of escaping it. You have to learn the 5 steps of recognizing revenue, what it is, right? All this IFRS 15, you have to know it. There is no way out. So make sure that you do it. Make sure. Now let us go to IFRS 15 in detail. When you are saying IFRS 15, you have to give some principles, some rules from IFRS 15 you have to list before you apply to the case study. That's how your answer has to be. Whenever you give any IFRS or IAS, first write the rule, what it says. Then you have to apply to your case study. So here revenue from contract with customers requires, what does it require? That non-cash consideration. Here mark the words. Non-cash consideration. Why? Because it is shares. Shares you are receiving, not cash. You are not getting cash for selling that 3-year license. You are getting shares. That is non-cash. So how are you going to deal in this IFRS 15 with the non-cash consideration? So here you have to be very careful. IFRS 15, it's a big one. When you say IFRS 15, don't start listing the 5 steps. Identify the transaction price, contractual obligation, then determine the, all those things don't write. Not relevant. You have to know what is exact to the case study. From the case study, how we are going to use that rule, IFRS 15, that you have to know. So here directly, it's a non-cash consideration, shares you are receiving. So you have to talk about non-cash consideration only in IFRS 15, not about the 5 steps. Okay. So it requires that non-cash consideration received should be measured at what? How it should be measured, because you have to tell how it had to be measured and recognized. That's what the question asked. Should be measured at, again I will highlight here, fair value of the consideration received. So the word fair value tells you another IFRS. To measure that fair value also there is another IFRS, IFRS 13. Now you see, IFRS 15, by looking at the word revenue, you can tell, okay, IFRS 15. But there is some IFRS I told you will be hidden in that. It will not be just one IFRS, it will be 2, 3. Not 4, not that much also, but sometimes 2, sometimes 3. If you are lucky, then 1. But it's not always 1. So don't assume it's just IFRS 15. If you missed out that IFRS 13, fair value measurement, then you have missed out a whole lot of marks. Each word matters a lot. Fair value, non-cash consideration. That's why it is highlighted. I have highlighted it. Okay, so now, next you are going to jump into fair value. Because you have to measure fair value, right? It has to be measured by fair value. So if fair value cannot be reasonably estimated, the consideration should be measured by reference to the standalone selling price of the good or service promised in the contract. Okay. The fair value of non-cash considerations may vary. If the non-cash consideration varies from reasons other than the form of the consideration, entities will apply the guidance in IFRS 15 relating to constraining variable consideration. Okay, make sure you read it and understand it by yourself. Reread it. After I finish, after you watch this video again, to yourself, reread it and see, are you understanding it or not? So if the non-cash consideration varies for reasons other than the form of the consideration, entities will apply IFRS 15. IFRS 15 they will apply. You have to tell them that entities, when they will apply IFRS 15, when they should not apply IFRS 15. Because you are recommending, right? You are the one who is advising. So you can tell, okay, apply this. They should apply this. They should not apply this. So entities will apply guidance in IFRS 15 relating to constraining variable consideration. However, if fair value varies only due to the form, the variable constraint guidance in IFRS 15 would not apply. This also you should write. Both the sides you have to write. In this case, the fair value varies due to the form. In this case, see the word they are using, in this case. In this case, which applies? The first one or second one? IFRS 15 should apply or should not apply? You told IFRS 15. Does not mean you have to apply it only. Depends on the facts of the case. So in this case, the fair value varies due to the form of the consideration. Exactly. Form of the consideration means fair value will vary because it's non-cash consideration. Therefore, which is equity shares. Exactly. And therefore, variable constant guidance in IFRS 15 does not apply. Does not apply. Next, when you have to talk about IFRS 13, go to the next paragraph. Leave a line, go to the next paragraph and then explain. Don't explain when there's more than one. Don't explain it in single paragraph. Keep separate paragraphs for each IFRS. IFRS 15, first paragraph, second is IFRS 13. So the fair valuation of shares in an unlisted startup companies are problematic. You have to tell this. You have to mention this because you know when it's unlisted, it is fair valuation is tough. It's difficult because you are not getting a valuation, market-based valuation for an unlisted company because clearly they have told this is an unlisted technology company, startup technology company. So the fair valuation of share is problematic here. However, IFRS 13, what is IFRS 13? Fair value measurement. Even if you forgot the name, what it is, fair value measurement, you remember the number is fine. Or you can just say fair value measurement, whatever it is. But the rule has to be the same. You cannot change the rule. Whatever IFRS 13 says, that you have to say. That you cannot forget. So IFRS 13 gives advice on how to measure unlisted shares. How to measure unlisted share they have told under IFRS 13. It sets out three approaches. What are the three approaches? You have to know the three approaches in IFRS 13. One is market approach, the second one is income approach, the third one is adjusted net asset approach. So if it's market approach, transaction price paid for the identical or similar instrument of an investee. Look at the similar price for the similar identical. If it is income, discounted cash flow or adjusted net asset approach. Now, third para, you are calculating. So here, in this case, the market approach has been used. Exactly, they have clearly told, right? 4 to 5 million or 6 to 7 million later it was changed. Market approach was used. So market approach has been used and the range of fair value is significant based upon the professional valuation report. So the range of the fair value was for a 7%. They have told all this are from the case study. I've highlighted also 7%. So the range of fair value for a 7% holding of shares would be how much? 280,000 to 350,000. How are they saying? Because the range was given to 4 to 5 million. So 7% of 4 million is 280,000. 7% of 5 million is 350,000. Here they have given in the bracket also. Give in a bracket like this to make it easy to understand. You don't have to show it in a separate working how you got 280 and 350,000. These are some small tips, techniques, smart techniques. Don't go and write under workings. Okay, this is how to it. You can write it in the bracket also. 7% of 4 and 5 million. Okay, and at the date of contract and this. Because later they have changed the valuation from 6 to 7 million. 7% of 6 is 420, 7% of 7 is 490. At the year end is changed. As the fair valuation is based upon a similar listed company and is based upon a controlling interest, a discount on the valuation of the share should be applied. A discount should be applied to reflect the lack of liquidity and inability to participate in DGY's policy decisions. What does this mean? Can you understand what it means? Read again. What it means. Here they told it's a controlling interest. What is a controlling interest? Controlling interest is very, you're controlling it. But you only have a 7% holding of share. Do you think with the 7% holding share you are controlling? No, you don't even have a significant influence there. So what it means? That valuation based on that, it should be discounted. That means valuation should be less. It should not be such big. Because that valuation is based on some controlling interest, but listed controlling interest. But first of all, you are unlisted, right? And you don't have a controlling interest. So because of that, a discount has to be there. Discount on valuation means your valuation has to be lower. You have to lower that valuation by that amount, taking into account that you are unlisted and you don't have a controlling interest. That means lack of liquidity and inability. You cannot participate in the DGY's policy decisions with 7% holding. So this is how you are giving the facts from the case study. Lack of liquidity, inability to participate in the policy. Thus, an estimated value of the shares can be made which takes into account the above facts. This could be the midpoint. Now you see here. Here's an area where you are using professional judgment when you are in a doubt what to do. You don't know how much to reduce, right? How much should I reduce? Okay, I told reduce, but how much? So in this condition, safe side, use average, use a midpoint. This is your professional judgment. You will be marked for this, right? It could be anything. You could even take a lower amount also. It says 280 to 350. You can just take 280,000, the lower one, or you can take the midpoint. So these are your professional judgment. It could be anything. Okay, so here they have told this could be the midpoint. 280 plus 350 divided by 2. Just add the lower and the upper amount and divide it by 2. 315,000 at the date of the contract, and at the year end 420 plus 490 divided by 2, it is this at the year end. DG buyer would therefore recognize a revenue of what? 315,000 for the receipt of shares from Classimac as the fair value of the non-cash considerations measured at the contract inception date. Remember, fair value of non-cash consideration is measured at which date? When the contract is inception date, 1st of Jan 2006. Don't take the year end. You're not taking the fair value of non-cash consideration the year end as a revenue. So that's why it's 315,000. This revenue would not be recognized at a point in time, but would be recognized over a period of the license, which is 3 years. Another very important, key important thing which most of the candidates miss at this point is you have to decide whether to recognize the revenue at a point in time or over a period. So here they said it should be recognized over a period, not at a point in time, over 3 years. License is for 3 years, no? So that revenue is not recognized in full, right? It's not recognized at a point in time, not in a single time. You cannot say this is the revenue. Over that 3 years, the revenue will be recognized. Key area. Mark it somewhere. Now I'm coming to the next. Clay Music Company share valuation at 31st December 2006. So first one was for revenue recognition. Now it is on 31st December 2006. Sorry, I will mark it. 31st is the year end. So here the shares would be recognized at this. We already have taken the midpoint of the last year at this date. All equity instruments. Now year end, you cannot use IFRS 15. IFRS 15 you have used it. Sorry, not IFRS 15. You have recognized the revenue in the contract inception, that is 1st of January 2006. What about the year end? How are you going to recognize, using which standard? This is what? Shares, no? Shares are what? Equity instruments, right? So equity instruments, it is dealt under which? This is how you question yourself and learn which IFRS will come. So equity investments are dealt under which IFRS? If you remember that, your problem is solved. IFRS 9. Exactly. IFRS 9. That's why it is IFRS 9. Because all equity instruments are in the scope of IFRS 9 financial estimate. Should be measured at what? So IFRS 9 says it should be measured at fair value in the statement of financial position. Here the valuation is different. Should be measured at fair value in the statement of financial position with value changes being recognized in P&L. Remember, they have told that they will be recognized in P&L or not. Value changes will be recognized in P&L. right? Don't stop here. Okay, you have to clearly specify why P&L only, because there are other ways, right, of recording. Through other comprehensive income also we can record, but why through P&L only? That you have to make it clear. By next line it says, if an equity instrument is not held for trading, an entity may make an irrevocable election. Irrevocable election means that election cannot be reversed again. Once it is made, it is made. Cannot be changed till later. So can make an irrevocable election at initial recognition to measure it at fair value through other comprehensive income with only dividend income recognized in P&L. That is only when investment is not held for trading. But here, this equity investment is held for trading or not? We'll read the next paragraph. So if DGY elects to represent the remeasurement through other comprehensive, see, if they elect to present the remeasurements through other comprehensive income, gains are never recycled through P&L. Yes, once they make that election through other comprehensive income, gain cannot be recycled in P&L. That's a rule of IFRS 9. This means that if the investment in classwork is successful when the investment is sold, there will be no profit or loss effect since all gains will already have been recognized in OCI. Definitely, when you sell the Clay Music company, the investment is sold, you will be getting a profit and loss, right? A profit or a loss. So that time you cannot recognize in P&L. That has to be recognized in OCI only. Because all the gains before that selling has been recognized in OCI. So now you cannot recognize in P&L. It cannot be recycled. Thus at the year end, a gain of, what is the gain? Year end and in the beginning, what is the revenue? That was 315. So 450 minus 315, this is the revenue. This is the gain, I'm sorry. At the year end, the gain of this one will be recorded in P&L or OCI dependent upon any election being made. So whether it's in this one or this one, it depends upon any election being made. If election is made, then OCI, otherwise P&L. Okay. Follow your IFRS 9 for more to know about this. Now coming to the next is royalty. Here they are saying royalty. And also you have to demonstrate how it is supported by revised conceptual framework financial report in 2018. So let's read about. Okay, we have already read it. So revenue royalty, let's read. As DGY retains an active role in the updating. So because DGY, they have told that they are the one who is going to update and maintain of a sold license to ensure its continuing value to the client. Revenue would be recognized over the expected length of the contract or related client relationship. Yes. We have told before also, revenue is recognized over the period, not at a single point in time. An entity must be expected to undertake activities which significantly affect the license to conclude that revenue is recognized over time. However, reliable measurement of future royalties is not available. See below. Thus, in this case, revenue would be recognized over the 3-year license based upon the license agreement at the year end. However, revenue from the royalties can be calculated based upon the sales for the period, and it would be how much? This much, because they told 5% is the royalty of 1 million. If you have forgot, then let me take you through the case study again. Royalty of 5% I have underlined here, and 1 million because here sale 1 million classical music. So for that, this is the royalty 50,000. Now that's not enough. You have to talk about the conceptual framework support, make it a separate subheading and write it under that. So the International Accounting Standard Board, the IASB, has changed the definition of income and expenses. Changed the definition of what income and expenses in the revised conceptual framework to align with the revised definitions of asset and liability. Because assets and liabilities definition has changed in the conceptual framework, what IASB has done, they have changed the definition of income and expenses also so that they are in line. So the definition of income encompasses increase in assets or decrease in liability which results in increase in equity other than those relating to contribution from holders of equity claims. It is directly I'm taking from that only, the definition of income. So the revised framework also states that an item which means the definition of an element which should only be recognized if it is provides users of financial statements with information which is useful. All these are from the framework only, so I can quickly read it. Nothing new. Framework defines useful information as what? So what is this useful information? Relevant and faithful representation. When you say information is useful, don't forget to mention it's relevant and it's faithful. These two properties has to be there. You have to write it. Relevance may not always be achieved if there's uncertainty over existence or the probability of inflow of economic benefit is low. Faithful representation will be affected by measurement uncertainty. Next, the last paragraph. You have to link this with the case study. So thus in this case, royalties, you have to talk about royalties here because it is asked in second part of B. So royalties cannot be measured with any certainty. Can you measure royalty with certainty? No. Cannot measure royalty with any certainty in the future and should not be recognized until certain, as only then it would meet the relevance and faithful representation threshold per the framework. Yes, the framework says you only have to measure something when it is relevant and it's faithful representation. But since royalty you cannot measure with certainty, so you cannot include it, because if you include it, it's not relevant also and it's not a faithful representation. So the definition and the framework related to income and recognition are therefore consistent with the approach taken by DGY. Yes, DGY told that they are not going to recognize it, so that they are consistent with that approach, with the definition of income and recognition. Now coming to the second part of B. Second part of B is about, we have so much of things to deal here. Classification of investment, derecognition of assets, then cryptocurrency, right? So for that we have to read investment in 4D company. Now when you go to the next, forget about what you have done previously. Unlock, just refresh. It's like how we have the refresh button, right? In the laptop we refresh, or in the phone we refresh your mind also. Take 1 or 2 seconds first before going to the next. Don't jump. I know it's hard, you panic, you try to finish it as early as possible, but this is a very small advice which if you follow from time to time will help you a lot. Trust me on this, because I do that and I've got enormous results. That is one of the reasons how I have passed SBR with 70%. I got 70 for SBR, right? Because I follow the small techniques, in small areas. 1 or 2 seconds, refresh, don't jump, don't start reading blah 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 blah. Forget about it. Delete what you've read. Now go to the next and start with a fresh. So investment in 4D. DGY company has agreed to work with tech game company to develop a new music platform. This is a different company, not as the same as Part A. On 31st December 2006, the company created a new entity, 4D company, with equal shareholders and shares in profit. DGY has contributed its own intellectual property in the form of employee expertise, cryptocurrencies with a carrying amount of 3 million, fair value of 4 million. So what is it? Wherever numbers are there, underline the number. Okay. And an office building is carrying amount of 6 million and fair value is 10 million. So the cryptocurrency is recorded at cost in DGY's financial statements. It is recorded at cost. Tech company has contributed the technology and marketing expertise. The board of 4D will compromise directors appointed equally by DGY, and tech company decisions are made by unanimous vote. Okay, very important. How decisions are made, how policies are, who is controlling, who is having significant influence. These are very important things to note about. Pension plan later, it's for part C. So now you have to, first part, classification of investment, second, derecognition of assets, and also gain or loss on disposal, and third we are talking about the cryptocurrency. One by one we'll deal. Okay, and number it also. When you write, number, like how this is the first one, this is the second one, this is the third one. So first, the word enormous concern says you something. Which IFRS? It is IFRS 11, joint arrangements. Right, this IFRS 11 is a small IFRS, does not come very frequently, but that does not mean that you should not study it at all and forget it. No IFRS and no IAS you should attempt touch each IFRS and IAS. and come prepared for SBR. If one also you forgot, and imagine if that only comes for your exam, then you are dead. You are nowhere. Trust me. It looks that it's okay, it's just one IFRS I forgot, so what, I will be able to cover up. No, it does not. You will lose a huge lot of marks. So let's read the first one. It seems that DigiWire and tech company jointly control 4D and it operates as through the arrangement is a joint venture. Though the arrangement is a joint venture, you have to name it. When two companies they are jointly controlling something, joint venture. It could be joint arrangement, it's a joint arrangement, right? IFRS 11, joint operation or joint venture. But this is joint venture. It looks like that. As parties, why IFRS 15 applies here? Why joint venture? You have to tell also. As parties have joint control of the arrangement and have rights to the net assets. They have right. Very important. These are very important. One is joint control, second is right to the net asset. So joint control, what is joint control? Defined. It's contractually agreed share of control of the arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. These are the key areas, keywords. This is the case with 4D company, right? You have to tell that this is the case with 4D company. Isn't it so? Just go back and see. I underlined also. Unanimous vote is required, then equal shareholdings and shares are in profit for both. Both of them are jointly sharing it. Now, a joint venturer recognizes his interest in a joint venture as an investment and accounts for that investment using the equity method in accordance with, there is another one in that IAS 28. Because when you record investment in a joint venture, how do you record it? Using equity method. And that equity method, okay, that is dealt in IAS 28, not IFRS 11. IFRS 11 you use to decide when it's a joint arrangement, when it's a joint venture. But IAS 28 to record it, measure it as an investment. So equity method in IAS 20, investment in associate and joint venture using the equity method unless the entity is exempted. Coming to the second one, de-recognition of asset and all those things. DGY has exchanged non-monetary assets for its investment in 4D company. What did it exchange? Non-monetary asset. And thus needs to de-recognize the asset it is contributing to 4D. It needs to de-recognize. The carrying amount of 6 million of the property is de-recognized, but the intellectual property of DGY has been generally generated internally and does not have a carrying amount. Remember that whenever intellectual property is generally generated, okay, you don't recognize it as intangible asset and does not have a carrying amount. And the carrying amount of 6 million of property is de-recognized. What is it? This 6 million office building. So here, the cryptocurrency, now we are talking about the cryptocurrency. The cryptocurrency is recorded as an asset in the financial statements of DGY at 3 million. The cost was 3 million, right? But will be valued at 4 million. Its fair value in the financial statements of 4D company, right? Fair value was 4 million. So you have to know how the fair value cryptocurrency will be recorded. Cryptocurrency is recorded as an asset in the financial statements of DGY. But in the financial statements of 4D, it will be at 4 million, the fair value. Now, next paragraph. But we are not going to talk much about cryptocurrency, how it is with the financial asset or intangible asset. That is in the third part. This is where it's very important that you read all the parts first. Otherwise, what happens is most of the time the third part's answer you are answering in the second part, which will not give you marks even though you are technically correct, because third part is third. You cannot repeat it again, you're wasting time. So if you ask something which you have to answer in the third part, don't answer it in the second part, even if it is somewhat similar. You wrote about cryptocurrency, leave as it is. Now, accordingly, when a joint venture contributes a non-monetary asset to a joint venture in exchange for an equity interest in the joint venture recognizes a portion of the gain or loss on disposal. So, joint venturer, what happens? Portion of the gain or loss on disposal. You cannot recognize the whole gain or loss because joint venture. Two companies are operating it, which is attributable to the other parties to the joint venture, which except when the contribution lacks commercial substance. Essentially, DGY is required by IAS 28. Required by which? IAS 28. To limit the profit on disposal of his non-monetary assets to 50%. Yes, 50-50. So effectively, you have to write the percentage, by the way. If it's two parties, then 50%. Effectively, DGY has already disposed of 50% of the asset contributed to the joint venture. Thus, the carrying amount of the joint venture in DGY's financial statements. What is the carrying amount of the joint venture? In DGY's financial statements at the date, write the date also. Write whose financial statement it is. In this case, it is DGY's financial statements. Right? Sorry, DGY will be this much. 11.5 million. How that 11.5 million comes? How does it come? 6 plus 3, because 6 is your building, right? Your property, and 3 is what? The cost of your cryptocurrency. It is recorded as an asset, right? So 6 plus 3 carrying amount de-recognized for property and cryptocurrency, plus what? A gain of 2.5 million. So 9 plus 2.5, which is 11.5. A gain of 2.5 million will be recorded in P&L. How that gain is recognized? The working is in the bracket here. If you see, 4 minus 3 divided by 2 plus 10 minus 6 divided by 2. You have to divide it by 2 because joint venture. They will both get 50-50%. That's why you're dividing it by 2. 4 minus 3, the fair value minus the cost. This is for the what? Cryptocurrency. And this is for the property. Fair value was 10 and cost was 6. Now, coming to the third part. How? Whether financial asset or intangible asset, cryptocurrency. This part is little, it's not tough. Once you read it carefully, understand it, it will be easy for you. Because IFRS 9, you know, as it is the most difficult, the complex in nature. So it takes some time for students to understand. If you read it first, you will not understand also. But nothing to worry. So now, cryptocurrency. If the cryptocurrency, now you see, they didn't say it means or not. They are saying if the word if it means this, what happens? If it means that, what happens? So if the cryptocurrency means the definition of financial asset, it is possible to measure it at fair value. Okay. However, cryptocurrency is not cash or cash equivalent, as its value is exposed to a significant change in market value, and hence there's no contractual right to receive either cash or cash equivalent. It's very important when you talk about financial asset that whether there's a contractual right to receive cash or not. The business model you're talking about. Here in this case, you also have to mention the properties of cryptocurrencies. What is it? Cryptocurrency is not cash or cash equivalent. That is one feature. So that's why the value is exposed to significant changes in market value, and there is no contractual right to receive cash or cash equivalent. That is another thing. So therefore, cryptocurrencies fail the definition of financial asset. Fails the definition of financial asset. That means it's not a financial asset because of these reasons. See how it is, how briefly they have kept, but everything is mentioned. All the important things they have mentioned only in 3 lines. This should be your way of writing. Writing everything important keywords, but minimum 3, 4 or 5 lines. Keeping it very brief. Not writing lengthy paragraphs. This saves your time also. You have written everything also. You have answered the requirement also. Next paragraph. If the cryptocurrency is to be recognized as an intangible asset, what happens? Then the default position would be to measure it at cost exactly. If something is at intangible asset, you measure it at cost. That's what the rule says. However, there may be an argument to say that there is an active market for the cryptocurrency. Yes, see, intangible asset, if you want to measure it, active market has to be there. No, not all intangible asset has a active market. And for cryptocurrency, it's hard. Okay, that there is an active market for the cryptocurrency, in which case it would be possible. See, not always, but yes, it is possible that this could be measured at fair value cryptocurrency because there's an active market. So in this case, movements in that fair value should be recognized through other comprehensive income, and gain would not be recycled through P&L when the cryptocurrency is realized. This you have to talk about because requirement also specifically told whether it will be recognized through P&L or not. It will be recognized through other comprehensive income, not P&L. It cannot be recycled in P&L when cryptocurrency is realized, when you're selling of the cryptocurrency. Why it is that? Go to intangible asset, then you will understand it better. Next, the best way to account for cryptocurrency would be fair value, as that is the value at which the entity will realize the investment or transfer in exchange for goods and services. Yes. So the best for cryptocurrency is fair value. Accounting for cryptocurrency at fair value with movements reflected in P&L would provide the most useful information to investors, but existing accounting requirements do not appear to permit this. Yes. They are saying that if you go by the cryptocurrency at fair value with movements in P&L, that is the most useful information, but this existing accounting requirements will not permit you to do that. You have to recognize through other comprehensive income. Now the last part C was for 3 marks. Let us read the requirements again. Reasons why it has been amended and why these two calculations, interest and net interest and current service costs, are considered necessary. 3 marks. But we didn't read that. Very small. So DigiWire provides a pension plan for its employee. From 1st of September 2006, DigiWire decided to curtail the plan and to limit the number of participants. They decided to curtail the plan, limit the number of participants. The employees were paid compensation for the plan assets, and some received termination benefits due to redundancy. Due to the curtailment, the currently monthly service cost changed from 9 million to 6 million. The relevant financial relevant to this one. So they have given you the net defined benefit and discount also. Right? Let us see. Even if for 3 marks, just see how much lines they are writing. How much they are writing for 3 marks. Before the amendment, IAS did not require entities to revise the assumptions for the calculation of current service costs and net interest during the accounting period. Even if an entity remeasure the net defined benefit liability, the asset in an event of plan amendment, curtailment, or settlement. The calculation was based on the actual assumptions at the start of the financial year. Okay, from IAS 19 only, you have to tell this. This paragraph has to be there. However, the IASB felt, IASB means I'm using the short form of International Accounting Standard Board, felt that it was inappropriate to ignore any. They felt that it was inappropriate to ignore before they ignored any update. Now they are including it because they felt it's inappropriate to ignore any updated assumptions when determining. Especially these two things you have to talk about because that's what asked in the requirement: current service cost and net interest for the period. Therefore, an amendment to IAS 19 states that a plan amendment, curtailment, or settlement occurs during the annual accounting period and entity must. So these two things has to be there. This and this. You have to write. Determine the current service cost for the remainder of the period after the plan amendment. After the plan amendment, curtailment, or settlement, using the actual assumptions used to remeasure the net defined benefit, liability, or asset. It could be a benefit or asset. Reflecting the benefits offered under the plan and the plan assets after that event. Next, here they talked about current service cost. Here they talk about net interest. So determine the net interest for the remainder of the period after the plan amendment, curtailment, settlement using net defined benefit, liability, asset, reflecting the benefits offered under plan and plan assets after that event and discount rate. So it's repeated from here. The wordings are repeated. Just here it is current service cost, here it is net interest, and the addition is this. Here the net interest means, of course, when you have to find interest, you have to talk about discount also. So the discount rate used to measure the remeasure. Okay, it's remeasure, updated remeasure. This, if you say measure, measure means first time you are measuring. Remeasure means second time updating. So make sure that these words are there. Discount rate used to remeasure that net defined benefit liability and asset. Coming to the next, here you have to do calculation. Now you see in the first part of C, if you write calculations, if you do calculations, you will be totally wrong because they didn't ask us anything about calculations. Second part is in fact the calculation. So, even though this word discuss why the changes to the calculation of the net interest and current service cost were considered necessary. Now it's very easy for you to do calculation because the word said calculation. That's why read full sentences and what it means. They told discuss why the changes to the calculation. They didn't tell you to calculate. So no calculation is required in the first part. Second part, yes, because they told calculation. Definitely they will give you calculation. It cannot be that it's full theory, because otherwise why the numbers is given to you. So using this number you have to calculate now. So if DGB has not applied the revised IS 99 current service would have been, if they have not applied this, what is the current service cost and net interest, and what if they have applied that, so that you can show the impact. So the current service cost will be this much. How is it 9 into 12 months? Because it is month from months. Let me show you. Because they told here before it was 9, it changed from 9 to 6. So 9 to 6, right? Current monthly service cost. For 1 month it is 9. For 12 months it will be 9 into 12, 108. Next, on the application of the revised standard, the current service would be. So if they have given the revised standard, what is the current service cost? It is 96 million. It reduced, right? 8 into 9 million, 4 plus 6 million. Now, this is an area where you can go wrong. You must have put 6 million into 12 months, right? And getting 72, which is wrong. Because just check the months, the year. Look at the date. From 1st of September 2006. 1st of September 2006, they are going to do this change. So September, October, November, December. 4 months. 4 months. That means remaining 8 months it will be 9 million. So only for 4 months it is 6 million after the revise. Here the dates are very important. Next. Thus there will be a reduction in the current service cost. Yes, from 108 to 96 the reduction is 12 million. Now let's go to the interest part. Similarly, the net interest component before the amendment would have been 3% of 30 million. Here also it will be 8 months because 1st of September it has been revised and 4 months. But the discount here it is, yeah, here it is 900,000, same only, and here 3.5% to 36 million. So this is after amendment, this is the one. So even this changed from this to this, it increased by 120,000, right? So the net effect will be to change the remeasurement component by this much. How you're changing it? Because your current service cost reduced by 12 million, net interest increased, right? So 12 million minus 0.12 million, or 12 million minus 120,000 is 11,880,000, right? 11,880,000. The difference between the net interest and the current service cost. Let's see how 3%, that is, we'll work out the percentages. Here it is on 30 you are taking the 3%. Then you are taking 36 into 3.5%. You are not taking this. So ignore this. From 1st of September 31st December you are taking 3.5% on 36. If you see here. Right? 3.5 and so that calculation is very important. Looking at the date, don't just take 31st December. Right? Because what it means here, with this we finished also. Question 3. What this means is on that last date it is 38. It has to be 39 and 3.7%. But from 1st of September to 31st December it is 3.5 on 36. That's what it means. So that said, with this we finished question 3 and the last question for this paper is remaining is question 4, which I'll be coming soon. So please don't forget to subscribe to my channel. Take care and best of luck.